Oh, hello. Yeah, Zeming here. This is a stock market god? What? The market is gonna drop another 30% in the next 3 months? Oh my god, I gotta sell everything right now. Welcome back to Hypergrowth. This is Zeming, and today we're gonna talk about the top 4 psychological traps that you should avoid during a stock market crash. These are mistakes that I've seen time and time over again, even from people who have extensive experience. I mean, even myself, I have to fight against these psychological urges all the time by following through on my discipline instead of buying into the psychology that can really mess you up during a stock market crash. So if you want to find out, stay tuned. The first psychological trap you should avoid is selling out of panic. I know everybody has heard of this, that the great Warren Buffett has said that be greedy while everybody else is fearful, and be fearful when everyone else is greedy. But in practice, it's actually really hard to do that sometimes, especially as we saw 2 weeks in the really a flash crash of the market. We saw 3 unprecedented meltdowns in a row within 1 week. At a moment like that, even many of my friends who are experienced investors in the stock market, they just start selling everything that they own indiscriminately, just based on the fear that, oh, everything can get worse and worse and worse in the next few months, and they will be able to buy later. However, you have to recognize that a drop like that oftentimes is not sustainable. It's just based around the fear that everybody is having in the market, which also might already price in so much of the uncertainty and the negative expectation. So what should you do in that scenario? I think the right things to do as a long-term investor is, first, you should look at your cash level. You have to make sure at a point like that, you have to have at least between 15 to 25% of cash in your account, so you can scoop up deals at a price instead of getting trapped without being able to, especially the companies of high quality that can for sure overcome a situation. Now, at the end of the day, you have to understand that even though you might see 30, 40, 50, 60% down in your portfolio in the short term, if you're buying into high quality companies that can come out eventually, these are just losses on paper that is not real money at the end of the day, unless you really sell. And if you really have the cash position as a disciplined investor would do to add to you at a low, you would definitely come out stronger on the other side. The second thing you should be doing is that really going through your portfolio one by one and making sure the companies that you own has the business model and the balance sheet to come out on top of this. If not, you have to be really careful with the risk and reward you're playing with right here. For example, one of my top position is Amazon. In the market crash 2 weeks ago, it actually dropped by more than 20% from $2,000 all the way down to really over $1,600. It might actually be seeing a surge due to people staying home and ordering more online. So that drop really doesn't reflect the nature of the business model. It's actually a better time to buy at that moment than to sell. Now, the trickier example will be Carnival Cruise. Take a symbol CCL. Yes, this is a company where you have to actually look at and ask yourself that, do they have a realistic chance of going out of business? And I actually think they do. However, that's also largely already priced into the stock. I mean, it's literally trading at single digits. I actually started buying into this company way before this current illness situation has started. Yes, this is definitely not my proudest investment, but looking at the price right now, you have to think that maybe the risk is worth the reward. Assuming that in 2-3 years, eventually the business can get back to normal, this is still a business model that can pump out billions of dollars in cash. And when you think about the chances that they eventually can be back to $40, $50, you're looking at least a 6, 7, 8x return. So I actually think that if you can handle the risk of being in a company that might go out of business, the upside reward at this price is also worth it. Again, at a point where so many people are fleeing the market based out of fear and panic, you have to really look at your portfolio and remind yourself that you're owning businesses, not stocks. And if you own high quality business, they will eventually come out better and stronger on the other side. Now, the second psychological trap is what I would call the "it will go down more tomorrow" trap. This is actually more for people who are holding a lot of cash, sitting on the sideline, or even people like me who are actively seeking to buy in the market. When we are actually in a stock market crash, like we saw in the week of March 18th, it's very, very hard to see your position go down 20% day after day after day, one meltdown after another. At that point, it's very easy to think that, oh, it will always go down more tomorrow. It will always go down more and more the next week. So I can always buy it down lower later. And many people who I know who has the cash and ready to buy just never got in because they always think that, oh, there's no way the market can bounce back and recover anytime soon. And it will only keep crashing. Only if I wait another 2 days, 5 days, 2 weeks, 4 weeks, that I can get a better price. However, it actually bottomed out right on the Thursday of that week. At least the bottom that we saw right now. And the only way you could have bought at a quote-unquote bottom is that by being brave enough to catch the falling knife. And this is exactly what I did. And looking back right now, I was able to scoop up shares of companies like Wynn Resort, which was just getting panic sold because it was in the travel and leisure industry. Even though when you actually look under the hood on their balance sheet, they actually have $2 billion in cash, not counting any revolver credit lines, which can easily last them more than a year of sustaining closure. And that's a case where it's completely different than Carnival, who has a realistic chance of bankruptcy. Wynn Resort was in a position where their stock was down more than 80% almost from their peak, but also they were in a much safer place long term. They really have no chance, in my opinion, realistically, of going out of business. Yes, in the next 1, 2, 3 years, it's gonna be painful, but I believe with very little doubt that gambling will be back. The casino industry will come back strong, and their business will be massively profitable again. If I just bought into the fear of like, oh, my position's already down 60%, there's no way it's gonna get better soon, so I might just wait and see it will always get lower later. I will always wait for the next day. I would have never been able to scoop up those shares at $35 a share. On the same day, I also get to buy into a Square at $35, Shopify in the low 300s, which is also an amazing company, although not cheap, that I love to be a part of, as well as Lululemon at $130 a share, which also bounced back less than a week later to almost $200. Now, did I make no mistakes? Of course not. I actually fell for this trap myself too. And actually is with my biggest position, Tesla. You know, during the same week, Tesla actually at some point dropped below $400 at just over $360 a share. I actually bought into the mindset that, oh, it can just go lower tomorrow. So I only bought 3 shares. Now, what I should have done is to remind myself that did the long-term potential for Tesla's business model as well as leading EV and autonomous vehicles just perish because of this illness situation? No, absolutely not. On maximum, it will get delayed by 6 months, a year, or at max 2 years. As well as compare that long-term potential to the objective stock price they're valued at. If I have just focused on those 2 things, which are the only 2 things as a long-term investor you should be asking yourself at this moment, I would have actually bought in much heavier at the price below $400, which I also had the cash position to make that purchase at the time as well. In summary, if you have the cash position and are ready to step in and buy, don't be afraid to catch dropping knife. Because at the end of the day, if you're buying high quality companies that can come out of this situation with no problem, at some of these prices, it's just a matter of whether you're getting 150% of return or 200% of a return in a 2 or 3 years of time frame. So yes, don't be afraid that it can drop down lower in the short term, which it absolutely can. If you can take a 50% hit on paper for companies you like, you shouldn't be investing in the stock market in the first place. Moving on, the third psychological trap is the classic fear of missing out. You really started to see this mindset coming to life when the market just started to rebound from a low of a significant crash, which is what happened since basically March 20th. Now all of a sudden, after the stock I mentioned before were up 10, 20, 30% in a matter of days, these people suddenly gained so much more confidence and started to stepping in. And because they feared that, oh, the market is gonna rebound more and I'm gonna miss out. And you can really see that this mindset, as well as the last one, is what really dictating a lot of retail investors' decision making. They're not really basing their decisions out of one, long-term potential and belief in the business model of a certain company, and the objective stock price they're seeing in the market, and whether that's justified compared to the reality. When you actually go in and read too much into the daily news and politics that comes out, yes, it's very easy to buy into the fear and expectations of the short term and actually miss out on the way more important long-term questions that you should be asking yourself. Personally, I was very happy with the fact that I didn't feel any pressure to buy more shares since the rally started on March 20th, because I was actually brave enough to catch a dropping knife and bought most of what I want at a lower price, maybe with the exception of Tesla. Overall, please don't buy into the FOMO mindset, fear of missing out, and jump in on a huge rally that you don't know even yourself is just justified. Even if you are thinking that the price is still good and you wanted to get in that you haven't before, don't rush in with all your money. Buy a little bit by being disciplined and only buying and selling a small portion at a time. You are able to offset actually most of the execution risk when it comes to timing the stock market. And the only thing you should be focusing about, again, is whether this company long-term has this business model and position to come back strong, and whether the price you're getting at is a good deal for that. Lastly, the fourth psychological trap that you should avoid is the mindset of, I can predict the market. To be honest, this is actually a huge mistake that I actually see more knowledgeable investors make, many of whom are way smarter than me, because they know so much about the market, the financial system, and they read a lot on the news of what's going on. They often develop stronger theory and higher conviction on where the market will go in 1 month, 3 months, or 6 months. But let me try to break it down to you why that might be a bad idea. In order to really predict the market right in a given time frame, you really have to get two things right. First, you have to be 100% right on your theory of why the market can go up and down in that given time frame. The second being that you pretty much have to beg that the stock market god are reacting in proportion of the reality that you're projecting. Even in the cases that you do time the market right, more than likely, the biggest element was luck. If we have learned anything in the past month or two, is that the stock market is incredibly irrational. Some days we're seeing the situation significantly worsen and the market can still rally off that just because how much fear and uncertainty was already priced in before. And some days you can actually see good news and the market actually takes a tumble. The thing is, you never know. To be honest, I'm always someone that's very reluctant to make huge plays based on macro predictions because one, there's just too many variables to be accounted for. Second, there are many things that are impossible to predict of what happens 3 months from now. And third, even if you think you know a lot, the chance of you getting it wrong is just way too high in a market that's so erratic. Truly, we're in unprecedented times. As humans, we like to come up with theories and use empirical patterns to justify our prediction about the future. But To be honest, I would just caution that don't get too attached to the historical patterns and theories when it comes to a really truly unprecedented crisis. Now, what I think you should do as a disciplined investor in executing your portfolio is that always play your card assuming that you might be wrong, which can mean that even if I have a decent conviction that the market can rebound to a higher level in 6 months, I would never piss away all my cash just buying right now and thinking it won't drop down lower. In the contrary, I can provide a counter example where I actually know of someone that had an all short position. He was actually making a killing during the drop we're seeing end of March. And I remember on the Thursday, that was actually the bottom that we have seen before. I asked whether he would actually trim his position in half or sell out completely. And he didn't. He held on to all of it. But the obvious mistake he made is that he was not prepared for the case that he was wrong. And that's one of the most dangerous things you can do managing a portfolio. Think about it. I don't care how much you like a company. The best advice I can give in executing is to always give yourself margin of error. I have no shame in saying that I've made plenty of mistakes in my investing life, especially when it comes to timing the market or individual stocks. But I generally still comes out on top because I always try to best understand the risk and be prepared for both the best case and worst case scenario. You can never be too careful. Let's quickly reiterate the 4 psychological traps that we talk about today. The first one being panic selling. Don't do that. Just don't. Unless you already sold 2 months ago, which congratulations. But never let fear overtake your decision making. The second one is what I call the it will always go down lower trap. If you're ready to buy and the price is right, go buy some. But never rush in too fast so you don't have enough room to add more in case it drops lower. The third trap is the fear of missing out trap. Just be patient, you'll always get another buying opportunity. And lastly, don't ever get too confident that you can predict the market. Always play for the case that you might be wrong. You can never give yourself too much margin of error. I hope all my mumbling was helpful. If you watch it this far, please smash the like button and comment down below what do you want to see next. I'm thinking doing an in-depth analysis of my top 5 positions or going through the top 5 stocks I'm looking to buy in the stock market crash right now.